Hello, everyone, and welcome to this week's edition of What's Driving Token Prices. I'm your host, Katie Talati, Director of Research at Arca. For those joining us for the first time, I'm responsible for identifying and analyzing digital asset and blockchain opportunities for Arca's funds. As part of our research, my team and I examine token events and the market. As part of our research, my team and I examine token prices and the market events that act as catalysts for price change. Based on our research and market events over the past week, here are some notable token price movements and what we think drove these moves. As a reminder, this commentary is not intended to be investment advice, investment research, or an investment recommendation. Please consult your investment professional for your own circumstances. Well, today has been particularly exciting. We've definitely had a bit of a market downturn since the morning session. For those of you who maybe haven't been following along as closely with crypto right now, a lot of the crypto market and Bitcoin price action has been driven by Michael Saylor's MicroStrategy, which has been kind of tinkering with several of its instruments that are impacting the price of Bitcoin. Related to that, also, Clarity Act has been inching along in Congress, but Donald Trump, the president, announced this morning that he will not be signing any other bills into law unless some of his voting rights bills get passed on that he wanted done. So a lot of people are now expecting that that bill may be dead and may not be passed. TBD, but that seems to be weighing on the market today. However, as always, we are here to talk about the tokens. So we will get right into it. So starting with Goldfinch Finance, or GFI. So it's come to light this week that Goldfinch Finance is officially shutting down their operations due to multiple borrower defaults, which have stymied any hope of asset recovery for many investors. So the Goldfinch protocol, they launched in 2021, and they were backed notably by big investors like A16Z, Coinbase Ventures. And the idea was that they were offering uncollateralized loans to small businesses in Africa and Asia and other kind of like developing areas. The protocol did, again, showed a lot of promise. Microloans are definitely something that a lot of people have been interested in as part of kind of the fintech revolution in the last 15 years. But this is one area that just not has panned out. The protocol did end up originating over about $100 million in loans, but according to data on DeFi Llama, about $56 million of those loans are still outstanding. And most of those are tied up in off-chain loans, many of which have have little to no recoverable value. So the way that Goldfinch worked is that it would source deposits on chain from investors, and then they would turn around and loan those out to these small businesses that were actually through intermediaries in those jurisdictions, not them immediately. But so far, they've had several default events, first one starting, I believe, in 2023. And since then, basically, the overall kind of that 100 million loan base has slowly dwindled down about by 50%. So the project has also just faced a lot of criticism for alleged poor underwriting quality, which has led to these numerous defaults. As part of the wind down efforts, though, the DAO did say they're going to establish a trust and they're going to attempt to recover additional assets for lenders over the next 2 or more years. The GFI token is down 99% from its peak price of $32. It is down 33% this week. Okay, next up, I'm going to talk about Injective protocol. They're a layer 1 blockchain. They announced this week that they actually launched an AI agent platform. So the platform has built-in ID verification. It uses the ERC 8004 standard, and basically also has a portable AI passport, tracks reputation, and a verifiable track record. The Injective block and it also allows trading fees that are generated by these AI agents to automatically be routed back to the agent. So the Injective blockchain is mostly focused on building financial applications to date. But as we've seen as of late across every industry, AI is really invading everything at the moment and proliferating everywhere. INJ, the token, though, was not immune from the market sell-off. It is down 23% for the week. Okay, so next we're going to talk about Synthetix. So on Tuesday, the decentralized derivatives protocol Synthetix voted to deprecate SUSD, which is its longtime stablecoin that it launched in 2018 under the old brand Haven. So for those who have not been in crypto as long as me, SUSD was actually one of the first synthetic stablecoins. It was backed completely by SNX. the Synthetix governance token, which at the time was a very novel idea and really allowed Synthetix's centralized derivatives exchange to scale back in 2020 and 2021. So the stablecoin did first experience issues when it depegged back in April of 2025. Basically, the protocol decided to change how SUSD is backed. Instead of staking individually your SUSD position, they created a shared debt pool for everybody staking SNX. This was done in an attempt to lower the collateralization ratio, which had risen to 750%. But it unfortunately had a bunch of unintended consequences, like creating this massive surplus of SUSD. And it also just disincentivized individuals from pursuing the arbitrage opportunity between SNX and SUSD, which is what had kept it kind of close to its peg for so long. So the proposal is going to allow holders of SUSD to exchange each dollar for 4 SNX tokens, which is subject to a 1-year lock followed by a 1-year linear vest. For context, SNX is trading at around like 25 cents. So basically you get a dollar worth back, but over a 2-year period. The Synthetix did state that SUSD will be replaced by a basis vault-backed stablecoin in the future. And that'll be powered by their new exchange, which they launched in December. So for context, like I said, at one point, SUSD had over $300 million in AUM, but it's since dwindled to about $11 million. And the stablecoin today trades at 25 cents. So quite a ways down from the $1 peg that it's supposed to be at. The SNX token, it's down about 17% this week. All right, finally, we're going to talk about ETH. It's been a while since we've gone over them, but over the past few months, if you haven't been following fairly closely, the Ethereum Foundation, or ETH for short, has just been rocked by a number of like high-level departures from the organization, funding challenges as the price of ETH has underperformed, and that's really led to kind of where they've had a bit of a kind of reckoning internally. So in addition to this, though, the new ETH mandate, which they published a few months ago, basically narrowed the ETH's focus to a point that many feel it didn't really support Ethereum fully. Finally, though, yesterday, ETH also announced that they're going to be laying off 20% of their staff and restructuring themselves. So this is, like I said, been kind of an ongoing debate. Ethereum has really underperformed. They haven't seen a lot of the success and even maybe as much adoption as they would have thought at this point in, in its development. It's also not necessarily the only one that's been winning a lot of like traditional finance tokenization deals. So a lot of people have started to be like, what is going on? Like, why can't Ethereum has so many bright people working on it? Why can't it do better? In response to a lot of the changes, though, at the ETH, a new group was also launched this week called Ethlabs. So Ethlabs was actually created and funded by a coalition across the Ethereum ecosystem, but the big supporters include Joe Lubin, head of Consensus, Bitmine, and SharpLink, which are both public digital asset treasury companies supporting ETH, and another group called SNZ Holdings, which is a venture studio. So they basically describe themselves as a nonprofit R&D lab for Ethereum and ETH. But they do state on their website that they're going to be focusing on supporting ETH, the asset, not just Ethereum, the blockchain, and DeFi, in addition to the broader Ethereum adoption story, whereas the ETH mandate was very narrow and did not include some of these things in it. To give you guys context of Ethereum's performance, it has declined significantly. It's trading today at around 1572. It's down 47% year to date. We know Bitcoin's down about 30, but 47% is quite a bit worse. And it's actually down about 60% since last August when prices were around $4,700. So it's really been pretty poor price performance as of late. ETH, though, just this week, it's only down 9.6%, holding in decently well with the sell-off. All right, that's all I have for you guys this week. I hope you enjoyed our insights. Tune in here again next Wednesday at 1 p.m. Pacific to hear what's driving token prices.